Hello guys, in today's video we'll be looking at liquidity engineering. As a forex trader, you must understand when liquidity is being engineered in the market so that you know how to take an informed decision, and where on the chart liquidity engineering usually takes place. Okay, so stay to the end, make sure you subscribe, make sure you like, share this video, and stay to the end because I'll be releasing some vital information for you. So without wasting time, liquidity engineering is simply the market building up liquidity, okay? And this tends to what induce traders, you and I, to buy and sell. And that's what it means, okay? For example, we might have a push down, okay? Now, normally, in a typical theoretical illustration of market structure, you say that this zone probably broke this low here and created a new leg. Now, instead of the market to come up straight here, mitigate this and move on, it does what is called liquidity engineering. It engineers liquidity so that traders will be what? Tempted to come in, induced to trade, and at the end of it all, the market will take all this liquidity, tap in here, and then continue the move. The whole of this is liquidity engineering, okay? So you have to anticipate the liquidity engineering to take place. And how do you do that? You do that with a very familiar features, you know, FVG. Most of the liquidity engineering takes place inside the FVG, and that is why I don't trade the FVG blindly, okay? Unless if I see liquidity that has been taken down, some kind of liquidity sweep without full mitigation, and I will still go ahead and enter the trade, because I've back tested most of these things for over a year now. So FVG, when you see FVG, think of what? Liquidity engineering. No one else is talking about this on the internet right now, so you are hearing it first here. I'm going to show you an example of a trade I took this week with my VIP members. As I said, the VIP members will commence in full swing next month. So if you are interested, use the link in the description and show me that you are interested, and I will book you in for next month. So this I will share a trade with you that I took on EURUSD, and I share this to the early subscribers to my monthly VIP group, where I share my trade idea, where you should come in, take profit, stop loss, and the rest. And also I'm going to show you if the trade is an high probability trade or a low probability trade. When the trade is high probability, you risk your normal maybe 1%, but if it's low probability, you can risk lower. And I will let you know that, okay, this trade is low probability, and therefore you adjust your risk. So without wasting time, we are going to quickly jump on the chart. Okay, when you see, some people say, what is fair value gap? In case you are here for the first time, a fair value gap is simply when market move aggressively either to the upside or to the downside, okay, without allowing most people's order to get filled. Okay, a lot of people want to get in here, but due to some reason the market moves so fast that it did not trigger them. Okay, then we have another candle, sorry. So your fair value gap is simply the first candle and the third candle. You take note of when you see a trade drop like this, bullish or bearish. In this case, bearish drop. You can also look at it in the form of bullish. For in this case, a bearish FVG, you have a three candles, drop, and drop. Okay, you are going to take note of the first candle low and the third candle high. This is your fair value gap. Now, The fair value gap, as I said in my previous video, if you don't see it, if you have not watched it, I will link it up here or check the card in the description. I said I do not trade the fair value gap. What I mean is, I don't trade the way most people trade the fair value gap. For example, when price comes back to this fair value gap, they tend to do this. When price comes in here, they buy and they sell, and stop loss just above that fair value gap. This, as I said, is very risky. This is a low probability trade. This is a low probability trade because often than not, price tends to close this fair value gap 100%, especially in the lower time frame. Okay, there are some exemptions to this, which I might share later. But if you are looking at pure market delivery, I don't trade this. Some people will also do this. They will take the 50%, probably for higher risk to reward. Price comes back in here, for example, this way. Price comes back in. Okay, they tend to take their trade from here and then continue the trade. Now, whatever method you use, I'm not condemning any method, just that I'm looking at it from the perspective of risk. The win rate of this method is very low. Okay, the win rate is low. We want to backtest, I can tell you the win rate is low because most times this happens. Okay, market comes, closes, and this is what I actually trade most of the time. Exemptions to this I might share later on, okay, or I might just share it with my VIP members only. So now, what this place is for is because most traders, both retail and these quote-unquote smart money traders, tend to trade in this fair value gap. There, the market creates what is called liquidity. They engineered liquidity in here. Okay, you would think, okay, there's a break, there's a chalk. In this case, you might see a fake change of character, and most people will be engaging this. Okay, the fair value gap is mostly used for liquidity engineering. Write it down. The fair value gap is mostly used for liquidity engineering. Before the market continues move, it must take liquidity. Okay, it must take liquidity. Sometimes that it doesn't feel 100%. If I'm satisfied with the liquidity that has been taken and it has not yet filled, I can still go in the trade, but this time around my stop will be above the hidden base. Okay, because there above the hidden base I have a lower risk than putting your stop just above the fair value gap. Okay, so I'm going to show you from the chart how we end up with trades during the week on Euro USD. So this is the Euro USD 15 minutes chart. When market broke structure, okay, to the downside, I can see it has been bearish, and this happens. I sent a setup to my VIP members, highlighting this zone here, this supply zone here. Before then, you can see this hidden base. I mean, this fair value gap, this blue candle, and this red candle here. All of these are fair value gap. You can see, let me draw a line here. This line and this line. So here you see what happened here when price came in here. This induces people to what? To take the short. And all of these are simply liquidity engineering. If you go to the 5 minutes, you see it clearly. So you can see all of these here, liquidity engineering. All of these, liquidity engineering. Okay, because that is what the fair value is mostly used for. The market uses fair value gap to tempt people to trade, to continue this short. But what happened eventually, price came in here and we got our entry and then we continue. because I'm not bothered if price comes in here and started going. I'm not bothered, because one way or the other, this first, especially this first liquidity, will be taken. The first liquidity will be taken most of the time. Okay, and then some people might take this to the bullish side. I wasn't interested in the bullish side because the trend was heavily bearish. So to show you, this was the setup. Now this is the setup here. Euro USD 15 minutes. You can see all of this here was a fair value gap, and I got the setup. I screenshot. Okay, I send this out because we want to continue this bearish move. So all we need to do is to wait for price to come back in here, and then we continue. Now all of these are playing zone for the market to induce inexperienced retail traders to engage in the continuation play. But if you come in here and your stop is above, fine, there's no problem, you are still going to be profitable. But because you are looking for better risk to reward, we are going to wait for price to come to this point, to close all this gap, okay, all this fair value gap. Then what happens? The market, as you can see here, the market came up, tap into this, okay, and then we continue the move down. Looking at this 1 hour, there was a 15 minutes, 15 minutes. So that was it. We took the trade. I'm going to put a screenshot of the proof here if I remember while editing. So the market moved low from there by how many pips? How many are rather, not in pips measurement. We held it up until this low. There was a target. I will not say it here, but my intention was to hold it for a swing trade anyway, to hold it longer. So this alone was around 6-hour trade, which we got more than that anyway. So I wanted to share this so that you understand how to trade fair value gap. Now if you look at here again, you can see this place here, we have fair value gaps here. We have fair value gaps here, you can see. Then we also have this one here, this and this. All of these are liquidity engineering. The market will then engineer liquidity in here within this fair value gap. You can see eventually price went up to mitigate the supply zone, and then the trend continued again. So most fair value gap, especially if you know your directional bias, you will not get this wrong. If you are the opposite side of the market, definitely you are wrong from the beginning. But if you know the direction, okay, of the market, then use this strategy, backtest it. Do not just follow me blindly. Backtest it and see if it's something you can use in your trading. If you want to understand more on fair value gap, I'll see you in this video.